Top-tier raw price action enables traders to concentrate on the single most critical factor, the price itself. In this video, we've collected some of the core price action indicators and tactics that are highly effective regardless of your chosen trading strategy. These approaches will support you in making smarter decisions and enhancing your overall trading performance. Today, we're going to walk you through how to spot these patterns on the chart, dive into the psychology that drives them, and show you how to apply them for more informed trading decisions. As always, tap the like button to help us keep producing content more frequently, and make sure to subscribe if you're here for the first time. Welcome back, and let's get started. Number 1. The inside bar validation. An inside bar is a candlestick formation made up of two candles. The initial one is large and known as the mother candle, while the second is smaller and stays entirely within the range of the first. The psychology driving this setup indicates a pause or indecision in the market following a strong upward or downward price movement. If the price moves above the high of the mother candle, it suggests the trend is likely to continue. On the other hand, a break below the mother candle's low points to a potential pullback or short-term reversal. This principle holds true in bearish market conditions as well. But here's the real question: how can we apply this concept in our actual trades? Let me walk you through an example. On this chart, we observe a strong uptrend. The price reacts to this zone with rejection, so we highlight it. When the price revisits this area, we can't treat the wick as a confirmed break of structure. That's because the wick signals a quick rejection back into the range, showing that buyers failed to push beyond the level. A true break of structure is confirmed only when the price breaks and closes above the level. Still, this doesn't ensure the trend will continue. If a fake out or liquidity grab occurs, the price could swiftly fall back into the range. This is exactly where the inside bar candlestick pattern becomes useful. When an inside bar forms right after a market structure break, it signals short-term uncertainty in the market. If the price then moves above this pattern, it suggests sellers attempted to drive the price back into the range but were unsuccessful. This confirms the breakout is legitimate and the price is more likely to continue rising. The same logic applies when analyzing sideways or ranging market conditions. In this scenario, we observe a consolidation phase where the price appears confined within a defined range. Two rejections from both the upper and lower boundaries are typically enough to confirm a ranging market. A common approach for trading in such conditions is to enter a position at the level during the third touch, setting your stop loss just above that zone and aiming for a target at the opposite end of the range. Alternatively, you can wait for a breakout to happen, where the resistance level flips into support, and then enter a buy position with your stop loss placed just beneath that zone. But how can we tell whether the breakout is real and not just a fake out? In a fake out scenario, the price falls back into the range, potentially resulting in a losing trade. However, if an inside bar confirmation pattern appears, it suggests sellers attempted to pull the price back into the range but were unsuccessful. This signals that buyers have taken control, increasing the chances of upward movement. You can also use this pattern directly as a trade entry setup. In a strong trending market, minor pullbacks are commonly observed. If you rely on waiting for these retracements to enter, you could miss valuable trade opportunities. That's where the inside bar setup proves useful. When this pattern appears, you can set a buy stop a few pips above the mother candle, with your stop loss placed just below it. This method offers one of the most effective ways to enter a trade without waiting for a deeper pullback. Now let's head over to the second signal, false breakouts. A fake out, also known as a false breakout, occurs when the price moves beyond a key structure level but swiftly retreats back into the range. For instance, during an uptrend, if the price breaks above a resistance level and later comes back to that zone, the resistance turns into support and a rejection is anticipated. However, if the market pushes straight through without showing any hesitation at the level, it's considered a fake out, signaling a strong change in momentum and pointing to a potential reversal or, at minimum, a correction toward the latest supply zone. So, how can this concept be applied when trading across various market scenarios? Let's begin with a ranging market. During consolidation, we can spot two key levels where price fluctuates back and forth. When price gets rejected from one boundary, it typically moves to retest the opposite side. But when a fake out takes place and the price falls back within the range, the likelihood of it reaching the other boundary becomes higher. Here's why. When the price breaks above a level, it activates buy stop orders, while stop losses are positioned just beneath that zone. As the price drops back into the range, those stop losses get triggered, adding bearish pressure and driving the price downward with momentum. Now let's talk about trending markets. How can we align this concept with market direction? In a clear downtrend, our focus should be on selling the pair. Sticking with the dominant trend boosts our chances of success. But entering at the wrong level might lead to a loss during a pullback, even if the price continues to drop afterward without you in the trade. In this scenario, the chart has formed a double top. Spotting a fake out above this resistance area gives an ideal short entry, signaling the beginning of bearish pressure. This is how you can merge market direction with the fake out concept. Keep in mind, always review the economic calendar before entering any position. Trading right before major news events is risky, as prices can spike or drop unexpectedly, no matter what the technicals show. Number 3. Dual peak and dual trough formation. Dual peak and dual trough formation. It's a widely recognized M-shaped reversal formation frequently used by price action traders. When a double top appears on the chart, it signals that the price couldn't form a new higher high, potentially due to factors like weakening momentum, a change in market structure, or reaching a significant level on a higher time frame. The safest method to trade this setup is by waiting for a break below the neckline to validate the reversal. The drawback, however, is that entering after the neckline break could result in a wider stop loss. One typical method of trading this pattern is to wait for a pullback to the neckline and watch for candlestick rejection signals to enter a trade, but the opportunity might be lost if no clear candlestick setup appears. To strengthen our trade setup, we can pair this pattern with the 61.8% Fibonacci retracement level. Once the neckline is broken, we use the Fibonacci retracement tool from the Indicators tab, drawing it from the beginning of the move to the end. Next, we set a sell limit order exactly at the 61.8% retracement mark. But here's the question: how can you tell when the move has ended before applying the retracement tool? The truth is, there's no way to be completely certain each time you draw it. If the market continues moving further, you'll need to reposition the tool to align with the most recent price action while waiting for a retracement. Keep in mind, if the price hits your target without pulling back, there's no longer a valid trade setup to consider. The same idea works in a bearish context. If the price gets rejected at a zone twice and completes the setup by closing below the neckline, we can apply the Fibonacci retracement tool and set sell limit orders at the 61.8% level. The stop loss should be positioned just above the swing high, and our target should be the next key structure level. But here's a crucial point: blindly trading every double top or bottom without proper context won't yield results. A better strategy is to identify major levels on higher timeframes that have seen repeated rejections, and then look for double top or bottom setups on a smaller time frame. Another option is to use smart money principles alongside it. For instance, picture this demand zone as an order block or a fair value gap on the higher time frame. After price returns to that zone and creates a double bottom reversal pattern, it becomes a strong setup to enter a long trade. In reality, blending smart money tactics with price action entries often leads to highly precise trade setups, since both techniques are extremely effective. Now let's move on to the next signal. Number 4. Contracting candle patterns. Contracting candle patterns describe a condition where the candle bodies gradually decrease in size as price moves closer to a supply or demand zone. On this chart, price touches a major resistance level and reverses. Observe how the candle bodies get smaller as price approaches this zone again. This pattern suggests a weakening in buyer strength, each candle covering less distance, signaling reduced momentum and a potential reversal from the resistance. In contrast, when price approaches the support level, there's no visible sign of weakening momentum, leading to a clean breakout through the zone. It is worth mentioning that this pattern works best when combined with another reversal pattern such as a doji candle or a long wick rejection. At the end. Number 5. Impulse candlestick setup. Impulse candlestick setup. This pattern features two back-to-back candles, where the second candle's body is noticeably larger than the first, signaling a potential shift in market momentum. The psychology behind this pattern reveals a surge of strong momentum entering the market, often signaling a continuation in the direction of the trend. It's especially powerful when the larger candle has little to no upper wick, showing that buyers, or sellers, were in full control right up to the close. When this pattern lines up with the broader market trend, it becomes a high probability trading opportunity. Here on the chart, you can clearly see the momentum candlestick patterns in action. Notice how the price accelerates upward shortly after these patterns form. While these signals alone may not be enough to justify a trade, combining them with other market concepts, like structure, key levels, or trend direction, can significantly improve your strategy and lead to more informed trading decisions. Let's move on to the next signal, number 6, ascending and descending wedge. A wedge pattern represents a phase of market consolidation where price action tightens, forming a condensing structure defined by two converging trend lines. The wedge pattern highlights a market phase with no clear direction, where buyers and sellers are battling for control. This tug of war creates a tightening structure marked by two converging trend lines. A breakout above a ascending wedge, especially during an uptrend, typically signals a continuation to the upside. Conversely, a break below a descending wedge in a downtrend suggests that bearish momentum may continue. However, not every breakout is legit. Fakeouts are common, where price briefly breaks the wedge but quickly re-enters the range. To avoid false signals, wait for confirmation, like a strong candlestick close outside the wedge or a retest of the breakout zone, before entering the trade. In a bullish setup, the first step is to wait for a break and close above the falling trend line. For stronger confirmation, a break above the previous market structure should follow. This indicates that the market has gained enough momentum to push higher. Once this breakout occurs, we start looking for entry signals to initiate a buy position. These signals may include price action cues such as a retest of the trendline combined with candlestick rejection patterns or reversal formations. To refine the entry further, you can apply the Fibonacci retracement tool from the beginning to the end of the breakout move. Then, place your buy limit order at the 61.8% retracement level, which is often a high probability zone for price to bounce from. Now let's move on to the next signal, number 7, merging premium trade setups. Merging premium trade setups. The most reliable trading setups form when several high-quality signals align, offering strong confirmation of market direction and increasing the probability of successful trades. In this example, we're in a clear downtrend. The market continues to print lower lows and lower highs, so we aim to trade in line with the dominant trend. A recent impulsive move has left behind an imbalance, so we mark the candle responsible for this move as our key supply zone. As the price retraces toward this zone, we notice shrinking candles, signaling a loss of bullish momentum. Then, a double top pattern forms, a classic sign of potential reversal. Right at this level of confluence, we get a long wick rejection candlestick, indicating strong selling pressure. Now, we wait for the neckline to break to the downside. Once confirmed, this provides a solid short entry. This setup includes several strong confluences: market structure, downtrend, supply zone, shrinking candles, momentum loss, double top pattern, rejection wick at resistance. All these factors combine to form a high probability trade setup. Key takeaway: learning to wait patiently for setups like this, and filtering out weak ones, is a critical skill for long-term trading success. If you found this video helpful, please like, subscribe, and stay tuned for the next episode. See you soon.